You see it every day in your feed. Perfect white slopes, chair lifts gliding over fresh powder, fairy tale main streets dusted in snow, stone fireplaces, whiskey in a heavy glass, a mountain view framed like a painting. It looks like the upgraded version of the American dream, a place you escape to once you've made it. That is the product Colorado's high country has been selling to the world for the last decade. But here's what almost nobody is saying out loud. That dream is cracking. For the first time in more than 10 years, Colorado's mountain towns are not just cooling off, they're in a real correction. And in some pockets, it's starting to look like a controlled crash. The pandemic gold rush, the Zoom town hysteria, the bidding wars on cabins and condos. That era is over. What's left behind is a mess. Distorted prices, stalled markets, a short term rental hangover, an insurance crisis, and communities that pushed locals out. Only to discover the investors aren't sticking around either. This isn't a soft landing. This is a full scale housing crisis in slow motion. Today, on a cross. Don't US 4. We're not doing a hype reel with drone shots and ski edits. We're taking you on a road trip and an investigation through 10 Colorado mountain towns where the damage is hitting hardest. We're going to count down from 10 to 1. With every stop, the numbers get uglier. The stories get more extreme. We're talking about price cuts so big they look like typos. Multi-million dollar chalets sitting on the market for a year, plus insurance premiums that turn owning into financial insanity, policies that tried to fix housing and ended up accelerating the crash. This isn't just a story about rich second homeowners getting burned. It's about entire towns hollowed out. It's about what happens when you bet an entire region on tourism, cheap money, and the myth that prices can only go up. And when we get to number 1, a town everyone assumed was untouchable, you'll see why even the top of the food chain is shaking. Let's start the engine. Number 10, Pagosa Springs, from short-term rental gold rush to standstill. We begin in the south, near the New Mexico border, rolling into Pagosa Springs. Most people know it for its hot springs, its slower, old Colorado vibe, the kind of quiet people thought they wanted after big city burnout. For a long time, that calm energy felt like a secret. Now, it feels stuck. Pagosa turned it into a textbook, short-term rental boomtown. Outside buyers poured in. Cabins, A-frames, and little chalets were scooped up for Airbnb and VRBO. Prices went way beyond what local incomes could justify. Everyone convinced themselves tourism money will always be there. Then reality walked in. Local leaders watched the housing stock disappear into STRs, while nurses, teachers, cops, and service workers scrambled for a place to live. The response: first, a pause on new short-term rental permits. Then, a hard cap on licenses. The second that cap became real, the investment story snapped. AirDNA shows future bookings down roughly 40%. That guaranteed cash flow investors underwrote their deals with? Gone. On the sales side, the Archuleta County Association of Realtors reports inventory of homes listed over $1 million, up about 95% year over year. These are the exact properties investors chased at the top. Now they're just sitting Zillow data. Typical listing in Pagosa, 130 days on market, more than 3x longer than 2 years ago. Redfin, roughly 1 in 3 listings has taken a price cut in the last month. Some cuts are 100K PS just to pull in showings. The real problem is the disconnect between local income and asking price. Colorado, Department of Labor, median household income in Archuleta County supports a home price near $350,000. Even after price drops, median listing still sits north of $700,000. Investors are stepping back. Local families can't step in. That leaves a market with too much inventory at the high end, almost no real buyers, and only one logical long-term direction. Down Pagosa is what happens when a town turns into an investment product, and the buyers lose faith. Was the short-term rental crackdown worth it if it helped trigger this kind of reset? Tell us what you think. Number 9, Durango, when a real town freezes over. From Pagosa, we head west along Highway 160 to Durango. This isn't just a ski base or a resort village. Durango has a college, a historic downtown, a year-round economy, actual locals who live and work here full-time, which is exactly why what's happening here should get your attention. It proves this isn't only a vacation town problem. It's what happens when unaffordability finally collides with reality. Durango is in a freeze, not a crash in prices, yet a collapse in activity. The Durango Area Association of Realtors reports total home sales volume down more than 50% compared with 2 years ago. That's not about price. That's about how many homes are actually changing hands. The answer? Not many. Why? Because owners are locked in by their loans. Many homeowners refinanced or bought at 2.53% interest rates. To sell and buy again means trading that for 6 to 7% plus. That's a payment shock most people won't touch, so they don't list. They sit. That keeps resale inventory artificially low. Even as real demand fades, builders don't have that luxury. La Plata County planning data shows a growing backlog of newly built luxury townhomes and condos, almost no pre-sales units standing finished or half finished with no buyers lined up. This is where the quiet freefall starts. Builders stack on incentives, 40K, 50K pools and closing credits, temporary interest rate buy downs, free upgrades that never hit the official list price on paper. Prices look okay. In reality, values are getting clipped deal by deal. Meanwhile, the local economy is flashing warning signs. For the first time in about 30 years, census figures show population growth basically flat. Young adults are leaving. Families are looking elsewhere because the math doesn't work. Align Durango reports average rent for a 2-bedroom assumes a 90K income. Median household income sits closer to 72K. That gap is brutal. Higher rates have also thinned out the wealthy cash buyers who used to step in and buy up inventory. What's left is sellers who don't want to sell buyers who can't or won't pay. A market that looks stable on the surface because no one is moving. Which is worse? A fast panic with visible pain, or a slow motion freeze where activity dies, and prices slowly get pulled down by gravity. Durango is giving us the second one. Number 8, Silverthorne. Too many units, not enough reality. We head back north into the I-70 corridor, rolling into Silverthorne. You might think you've never heard of it. You've almost definitely driven past it. For years, Silverthorne was framed as more affordable Summit County, the outlet mall town you pass on the way to Keystone or Breckenridge, the place you could still get in if Slopeside was out of reach. Now it's ground zero for overbuilding. Drive around town and you'll see half-finished condo projects, new developments exposed to the weather, coming soon. Signs that have been there way too long. Developers bet on pandemic-era demand lasting forever. Cheap money made it easy. Ultra low rates. Loose underwriting. Investors snapping up pre-construction units. The problem now? There are too many units and not enough buyers. The Summit County Association of Realtors reports new construction homes on the market in and around Silverthorne up 145% year over year Zillow. Typical listing, 128 days on market, about 3x longer than 2 years ago, Redfin. Roughly 45% plus of active listings have taken price cuts, often in 50K chunks, sometimes more. Then came policy. The town tightened short-term rental rules, new caps, stricter zones, less freedom to flip a new unit into a nightly rental machine, air DNA data. In non-exempt zones, future bookings are cut roughly in half. So the investor math that used to work here has collapsed. Less rental income. Higher rates, higher HOA, dues, and insurance. More competition now. Add the income versus price gap. Colorado Department of Labor, local median income supports 400K, median home price still near 900K, locals can't buy. Investors don't see profit. Census estimates. Population declining for the first time in solid 20 years. You end up with a pipeline of too many units, not enough real demand, and early signs of a town drifting toward off-season emptiness. Silverthorne is not just a local problem. It's a preview of what happens when cheap money, aggressive building STR speculation, and reactionary policy all slam into each other. Number 7, Crested Butte. The authentic luxury market hits a wall. We leave the interstate and drive a long, winding road into one of the most remote, iconic spots in the state, Crested Butte. This is the image in people's heads when they think of classic mountain town, historic Main Street, tight building codes, protected views, almost aggressively charming for years. Crested Butte branded itself as the anti-veil, real Colorado. No mega villages, no corporate feel. Ironically, that supposed authenticity attracted serious money. Hedge fund managers, tech founders, quietly loaded families. Prices were pushed until the median home sat above $2 million. Now, that market is seizing up. The Crested Butte and Gunnison Association of Realtors shows total sales volume down, less than 60% transactions above $3, down around 80%. High-end buyers have absorbed the shock of higher rates, shaky markets, and other options. Many simply stepped away. On the ground, average days on market, 210 days. That's roughly 7 months waiting for a buyer. Redfin. Nearly half of active listings have taken at least one price cut. Beneath the visible slowdown is something more structural, a multi-year fight over short-term rentals, a 2-year pause on many new STR permits, uncertainty that froze part of the market. Now layer on insurance, remote location, heavy snow loads, wildfire risk. One broker described a $4 million home facing a $70,000 per year insurance quote. That's almost $6,000 a month just to insure the building before mortgage, taxes, maintenance. The whole market was powered by the belief there will always be a richer buyer behind me. The greater fool theory. Now the line of richer fools is gone. The true billionaires can wait this out indefinitely. Everyone else who needs to sell faces real pain. Crested Butte proves a hard truth. Even authentic, carefully protected towns are still brands. And right now, that brand is hard to sell when liquidity disappears. Number 6, Steamboat Springs, when a town prices out its own future. We head far north to Steamboat Springs. This is Ski Town, USA, ranching roots. A real high school football team, a community that existed long before the latest tech money showed up. It's not a resort fabricated from nothing. It's a real town. And it's cracking. In the last 5 years, Steamboat leaned hard into the luxury wave. Second homes, high-end condos, ranches marketed globally. The result? According to the Yampa Valley Economic Council, median home price doubled between 2019 and 2023. Local wages rose 8%. You don't need a finance degree to see the problem. That gap triggered a quiet exodus. The school district reports roughly a 10% enrollment drop in 1 year. Classrooms emptying out families, packing up and leaving UC Health Yampa Valley Medical Center, warns of a staffing crisis. Nurses and support staff can't afford to live anywhere near town. The people who make a place function, teachers, police, hospital staff, service workers, cannot live in the place they serve. Meanwhile, the housing market is starting to sag under its own weight. Steamboat Springs Board of Realtors, single family sales volume down, 40% condo market hit even harder. Steamboat is packed with older buildings, many built in the 1980s, high HOAs, constant maintenance. A new aggressive short-term rental tax has erased a lot of the profit from older units, made many condos financially unattractive as investments. Data shows condo inventory up 120% plus. A local appraisal study, prices down almost 25% from peak units that sold for $900K a couple of years ago. Now struggle to get offers at $650K. It's a two-tier disaster. At the top, multi-million dollar properties just sitting. At the lower end, supposedly affordable units racing downward as owners try to exit rising costs and taxes. And in the middle, there is no middle. The middle class buyers who used to anchor the market are vanishing. Steamboat isn't just Ski Town, USA anymore. It's a warning label about what happens when a town systematically chooses property values over people and then realizes someone actually has to live there. Number 5, Breckenridge. When a tourism machine overheats back into Summit County, we arrive in Breckenridge. Everyone knows this name. A once scruffy mining town turned into a polished tourism machine. More than 3 million visitors a year. Boutiques, bars, slopes, events. A full-blown brand for years. Owning in Breck felt like a can't-lose play. Not anymore. Breckenridge is dealing with 3 problems at once. It became too expensive. It became too crowded. It became too regulated. In an attempt to fix employee housing shortages and calm local anger, the town and county went hard at short-term rentals, strict caps, restricted zones, license limits. The Summit County Association of Realtors has said bluntly, these policies wiped out 1,030% of values in some segments. Overnight, AirDNA confirms short-term rental revenue in newly restricted zones down to go 70%. That's not a haircut. That's an amputation. Investors who built entire spreadsheets around STR income are now negative cash flow, facing higher rates. Watching bookings fall off, many are being forced to sell. The problem? There are not enough buyers at these prices. Zillow data. Active inventory in Breckenridge up 90% compared to a year ago. Land Title Guarantee Company. Closed sales have fallen for 6 consecutive quarters. That's not a seasonal dip. That looks like the front edge of a real downturn. Main Street tells its own story. Breckenridge Main Street Business Group reports about 45 vacant storefronts on or near the Strip. The highest in town history. Tourists still come, but they stay fewer nights, spend less per trip, choose day trips from cheaper bases. On paper, median home price still above 1.5. In reality, Zillow shows average sale to list ratio at 92%, meaning typical homes sell about 8% below their already reduced asking price. Breckenridge is starting to resemble a theme park in winter, a near ghost town in shoulder seasons. The housing market is mirroring that instability, rotating between manic and empty. Number 4, Telluride, when the ultra-luxury buyer disappears. To get to Telluride, you have to really want to be there. It's a deep-in-a-box canyon in southwest Colorado. Towering cliffs, dramatic scenery. A town that feels like a movie set. This is where billionaires dress like ski bums and pretend they're off the grid. For years, Telluride felt insulated from normal economics. You weren't buying a house, you were buying into a private club. That illusion is fading. The Telluride Association of Realtors reports sales above $5 down roughly 85%. Read that again. The pipeline of ultra-wealthy buyers who used to show up from California, Texas, New York, drop 7-10 mailers on a fun place has dried up. Inventory in the 5-10 mail range is up 50% average days on market, creeping toward 300 days. That's basically a full year. Meanwhile, basic living costs are insane. Town economic data. A gallon of milk can hit $12. Service workers cannot live anywhere near the canyon. Employees are bussed in from towns up to 2 hours away. Census data, median age, up by under 6 years in a decade. The town is aging into a part-time wealthy enclave. Insurance adds another major problem: wildfire risk. Climate concerns narrow canyon vulnerability. Big insurers like State Farm and Allstate are pulling back, limiting new policies. If you can't insure a home, you generally can't finance it. That turns huge parts of the market into cash-only trophies, illiquid assets that only a tiny fraction of the world can realistically buy. Telluride looks gorgeous, but behind that image are recent buyers, likely underwater owners, quietly cutting expectations. A town shifting from living community to curated museum of high-end homes. Number 3, Dillon. The overlooked pressure valve starts to crack. Next up, Dillon. You've probably driven past it without giving it much thought. Then you look across Lake Dillon at night, a ring of lights around the water, condos stacked up the hill, a town hiding in plain sight. For years, Dillon played background to Breckenridge, Keystone, Copper. When those markets went insane, buyers and workers spilled into Dillon. Cheaper condos with lake views, quick freeway access to multiple resorts, investors turning old motels and basic units into short-term rentals. Dillon became the overflow valve for the I-70 resort machine. Then the same pattern hit. Locals angry about housing costs. Town leaders pushed back on STRs. Caps and license limits tightened the screws. Investors holding older units suddenly had less flexibility, higher insurance climbing HOA dues. If those units can't cash flow as short-term rentals, they either convert to long-term rentals at lower yields or hit the market for sale in a town where working families are already squeezed out. Meanwhile, costs keep going up. Utilities, dues, groceries, gas, resort wages, not rising at the same pace. Working residents who once saw Dillon as the affordable option now commute from even farther away, spend more time in traffic on the same interstate they used to praise. Looking at listings, you see, more homes for sale, longer days on market, a rising wave of price cuts on dated condos that need serious work. On one side, investors who bought near peak now hit with STR restrictions, higher holding costs, higher rates. On the other side, local workers and families priced out of even basic units. So you get a strange tension. From the highway and marina, Dillon looks full. On the ground, it feels more hollow and temporary. If the bigger resorts and regional housing systems really start to fail, towns like Dillon, the support towns that quietly keep everything running, will be the first to show structural cracks. Number 2, Vail. The original luxury product becomes old. Now we arrive at the legend Vail. Even people who know nothing about skiing know this name. Vail was built from scratch to be a perfect alpine resort. Shops, slopes, restaurants, all choreographed. A controlled world for people with money. For half a century, buying in Vail meant you can always sell. There's always demand. It never really goes down. That narrative is breaking. Vail is being hit on three fronts: aging properties, enormous carrying costs, competition from newer, more efficient luxury markets. Start with carrying costs. Local data. Average condo. HOA in Vail Village is $2,000 a month. That's $24,000 a year, just in dues. Add taxes, insurance, maintenance, maybe club memberships before you even touch debt service. The Vail Board of Realtors reports total sales in the core village down 70% from peak levels. There's also a generational shift. Younger millionaires and billionaires can choose. Jackson Hole, Big Sky, Utah's new private club resorts, international options. These places offer newer buildings, lower operating costs, less regulatory baggage, less 1980s. Infrastructure, Vail's core inventory is old. Many units built early 1980s. Outdated systems, full gut renovations often cost $500K plus, so a buyer looking at a $5 million condo has to factor. Purchase price, massive renovation, huge monthly fees. Redfin data, median time on market, 180 days, about 6 months. Local MLS, average price cuts hovering near 12% on a $5 million unit. That's a $600K discount just to keep deals moving. Vail's town budget also feels it. Sales tax revenue shortfalls in the tens of millions. Visitor spending is softening. Census data shows a slowly shrinking full-time population. More units become rarely used second or third homes. Fewer people actually live here. Vail isn't just going through a dip. It's confronting an identity crisis. Are we still the premier product, or are we the aging version of a model the market has already moved on from? Number 1, Aspen. The top of the pyramid starts to crumble. We end in a valley with a name that echoes worldwide. Aspen. Aspen isn't just a ski town. It's a global status symbol. For decades, executive celebrities, ultra high net worth families used Aspen as a place to disappear from the spotlight while proving to each other they could afford to be here. The saying used to be, prices in Aspen don't go down. Today, that line is a joke. The pandemic created a super bubble here. Remote work, easy money, a wave of wealthy buyers desperate for safe, beautiful places, prices detached from any local or rational base. Now the hangover is here. The Aspen Glenwood MLS reports median single-family home price down 32% from peak. That means a $40 million property now selling closer to $28 million, billions in paper wealth erased. Transaction counts, total deal, volume down 65%. The buyer pool, remote work executives called back to HQ families, shifting to other elite destinations. Some simply overexposed and less willing to park capital in one zip code. Inventory, active listings up 200% plus. Zillow, average days on market around 275 days. That's 9 months sitting on a multi-million-dollar asset. Pitkin County assessor and local business reports show commercial tax base eroding as high-end stores see sales drops near 50%. Boutiques and galleries depend on a constant churn of wealthy visitors. When those visitors spend less or stay away, downtown starts to feel emptier. Census data adds a final piece. More than 60% of homes in Aspen are vacant over 10 months a year. Aspen has become a part-time city, a place of dark windows and empty mansions for most of the year. This is the wealth story in reverse. Instead of fresh money pouring in and lifting everything, capital is quietly rotating out, or at least refusing to pay yesterday's fantasy prices. Aspen was built on the assumption demand here is limitless. It wasn't. Every market has a breaking point. When a place becomes so expensive, so detached from normal life, and so reliant on the next wave of rich buyers, any shock, rates, markets, policy shifts, lifestyle shifts, can expose how fragile that setup is. Aspen is now the clearest example of a mountain housing market that lost contact with reality. and is paying the price. The road trip summary: what this collapse really means from investor panic in Pagosa Springs, stalled luxury builds in Silverthorne, workforce exodus in Steamboat, STR policy shocks in Breckenridge, ultra-luxury stalls in Telluride and Aspen. The same pattern keeps repeating: cheap money, pandemic demand, supercharged prices, construction, speculation, short-term rental gold rush, locals priced out, homes converted to mini hotels, policy backlash, STR caps, taxes and restrictions hit investors hard, higher rates, the math breaks, payments jump, buyers pause, insurance and operating costs explode, wildfires, snow, aging buildings drive premiums and dues up. Real demand fades. Locals can't afford. Investors can't justify. Wealthy buyers have options. What you're seeing now is not a gentle rebalancing. In many of these markets, volume is collapsing. Prices are slipping or diving. Liquidity is drying up, and the people who thought they were holding safe assets are learning. Safety is not guaranteed. If you're thinking about buying into these markets, this isn't fear-mongering. It's a warning. Don't anchor on 2021 prices. Don't assume it always comes back. Don't underestimate carrying costs, insurance, HOA, taxes. Don't ignore local policy and regulation risk. If you bought near the top, this is the new reality. You might be underwater on paper. You might be locked into a high-risk, low-yield asset. Your exit might take longer and cost more than you ever expected. The avalanche has already started. Nobody knows exactly where the debris field stops. If this deep dive opened your eyes to what's happening behind the glossy marketing, hit like share it with someone thinking about buying a place in the mountains, and subscribe to Across the US 4 for more investigations into what's really going on in America's housing markets, not the brochure version. Drop a comment. Which town on this list surprised you most? Where should we go and dissect next? Thanks for watching. Stay sharp, stay patient, and don't confuse a pretty view with a smart investment.